Welcome to first and only SaaS News Digest featured on LinkedIn, covering news, events, and updates that are happening in the SaaS community worldwide. We're going to start today's digest with a look at Hopin, the new online digital event platform. Hopin was recently valued at $2.1 billion, but many are wondering about this high valuation. SaaS businesses are looking at all-time high revenue multiples, usually ranging from 10x to 20x. But Hopin's investors arrived at the amazing 100x of their $20 million ARR at the time of their Series B round. And experts believe that this high valuation is because of two main factors. First, Zoom. Hopin's closest public market comparable traded at 96x. And Hopin's average month-to-month growth rate has been 50% since May. They reached $20 million of ARR in only 8 months, something that took Zoom about 3 years to accomplish. And Hopin doesn't need to sustain its current growth rate after the pandemic to succeed. According to one expert, 5 years to hit $100 million ARR is the gold standard when it comes to software investing. At Hopin's current growth rate, they hit that milestone within a year. And within $1.1 trillion global events market, Hopin only needs to capture 0.01%. Customers have been finding the platform organically, which also has led to massive savings in marketing and sales. Claiming 3.5 million users already, Hopin has worked with 50,000 organizations since March. All of this means that Hopin's valuation might be aggressive, but it makes sense as long as the SaaS revenue multiples stays where they are. They have the market, product, and opportunity to become a hugely successful SaaS business. Our next digest covers a recent Fortune.com article that asked readers for their prediction for 2021. Many readers seem to believe strongly that San Francisco will survive its current challenges. A new generation of smart builders are expected to continue migrating to the Bay Area. And this belief comes alongside the prediction that we'll also see capital and talent spread elsewhere. Over the coming years, micro-communities are expected to emerge across the country. And this happens, many respondents also mention a wave of people leaving cities. And with real estate being the second largest cost for organizations, we will see dramatic internal shifts in how corporate funding is distributed. Many will continue working from home, transforming real estate footprint and shaking up the commercial real estate sector. And as more startups focus on the home, we will likely to see more disruptions of traditional services like deliveries, landscaping, and cleaning. Many also believe that 2021 will see valuations start to return to more normal states. There may be a need to justify valuations as earnings multiples come in line with COVID and post-COVID economic realities. And it seems that many people believe that office culture is not dead at all. Rather, they believe that the future holds a working hybrid that includes working to office, but with increase of flexibility. Human resource tech is expected to have a huge year in 2021 as companies focus on employee collaboration and engagement. Investors also predict increased interest in government tech as stimulus funds create opportunities for American venture-backed startups. And all of this will come with increased need for cybersecurity and privacy protection. COVID exposes many vulnerabilities that will be addressed with the rapid adaptation of zero-trust security frameworks. And finally, many predict that 2021 could be one of the hottest years for merger and acquisition, as well as the IPOs. Big tech companies have cash hoards that will use across the board to better their standing. Cloud, fintech, and healthcare and product management are expected to see big buys. Also anticipated this wave of acquisitions in cybersecurity space. Our last digest today takes a look at cross-border M&As between US and Israel. The cross-border tech sector remained strong this year despite obvious challenges. There was a decrease in the number of deals with only 41 this year, compared to last year, 51. The percentage of tech deals by US buyers rose almost 20%. And it's also worth noting that the average deal increased by an amazing 144%. In 2019, the average deal size was $200 million. In 2020, we saw that jump to an average deal price of $490 million. Sector-by-sector analysts show a big jump in SaaS deals, with 7 in 2020 compared to only 3 in 2019. One SaaS deal worth mentioning involves Checkmarx, a software security solution. Checkmarx was acquired by Hellman and Friedman in March for $1.15 billion. The increase in US buyers of Israeli tech is due to, at least in part, to the pandemic, and M&As with European and Asian companies dropped while US players stayed as active as they were in 2019. Some believe this is testament to a strong US-Israel commercial ties that have been strengthened over decades. And in fact, that some experts say that the Israeli tech entrepreneurs were wired to create companies for the US market. They are focused on working with US corporate customers, investors, and inquirers. And this builds as foundation for growth projections that span larger total available markets. Other experts say that Israeli tech has a similar risk-taking atmosphere to Silicon Valley, and they have plenty of highly skilled young engineers funded by a massive local venture capital industry. We can expect to see more growth here as Israel continues to demonstrate the maturity of their tech sector. I hope you enjoyed the SaaS News Digest. The SaaS Digest belongs to all of us and provides value to the members of our community because of you. So please click on like or insightful button and share the SaaS Digest on your page. And let's work together in developing this community and setting new SaaS global standards. My name is Artem Gassan. I'm a general partner at SaaS Growth Ventures, and my superpower is I fuel growth and revenue for SaaS companies. Thank you for watching. I'll see you next week.